Welcome to Iron Financial. This is the place where we help you forge a stronger, more resilient portfolio by cutting right through all the market noise. And today? Well, today we're putting on the hard hats and we are taking a sledgehammer to the walls of Scotiabank's latest earnings report. Now, on the surface, the headline numbers absolutely screamed victory. We're talking a blockbuster quarter by pretty much any measure you can think of. But the market's reaction? That told a completely different story, a story filled with doubts and hesitation. So we're here to do what we always do. We're going to dig deep into the numbers, we're going to stress test the foundation, and we're going to figure out once and for all if Scotiabank is actually building a financial fortress for the future, or if this whole thing is just an elaborate, well-polished facade. All right, let's get to work. Okay, let's just stop right there for a second. Before we dive headfirst into the income statement and get lost in all the accounting jargon, we need to put the central conflict right here on the table. Because this, right here, is the entire puzzle that the market is frantically trying to solve. Think about it. You see a headline that just screams by an absolutely explosive triple-digit profit increase. And then you glance over at the stock ticker and it just whispers sell. Net income goes through the roof, but the stock itself actually gets punished on the very day that the good news comes out. Now look, this isn't just some random market noise. This is a really powerful signal. It's the market telling us loud and clear that the real story here is a heck of a lot more complex than one big shiny number. So, the question for your portfolio has to be this. Is this just a massive overreaction from a skittish, nervous market? Or are the big professional investors, the smart money, seeing deep, structural cracks in the foundation that just aren't visible in that glossy press release? That is the real story we have to uncover today. In this slide, this just lays out that contradiction perfectly. Just look at these two metrics sitting right there side by side. On the left, you've got a reported net income of $2.3 billion. That's a staggering, almost unbelievable 131% increase from the $993 million they posted this time last year. Let that sink in. It's more than double. In pretty much any other situation, that's a home run, a grand slam. It's a clear sign of a business that's just firing on all cylinders. But then your eyes drift over to the right. And what was the market's verdict on this amazing news? A 1.65% drop on earnings day. That is what you call a cold shoulder. That is the institutional money, the big funds, looking at that massive profit beat and basically saying, yeah, we are not impressed. So our mission today is crystal clear. We need to break this report down, piece by piece. We have to separate the one-time accounting gains from the actual core operational strength of the bank and figure out if the bull case or the bear case is the one that's actually built on solid ground. To really truly understand the bull case for Scotiabank right now, you have to appreciate the incredible amount of heavy lifting that management has been doing behind the scenes for the past year. This is not a story about one good quarter of loan growth or, a favorable interest rate environment. No, this is about a fundamental, strategic overhaul of the entire institution. They are quite deliberately reforging the very core of this bank. They're tearing down huge parts of the old structure in order to build something stronger, something leaner, and something way more resilient in its place. So first, let's take a look at what they've demolished, and then we'll inspect the new foundation they're trying to build. So where on earth did that incredible 131% profit jump actually come from? I can tell you it wasn't from some sudden explosion in their Canadian mortgage business. No, the answer is found in what's not on their books anymore. You see, last year's Q1 numbers were dragged way down by a colossal impairment loss. We're talking over $1.3 billion. And it was all related to the planned sale of these exact operations you see here. Now that those sales are complete, specifically their banking operations in Colombia, Costa Rica, and Panama to a company called Davivienda Group, and their consumer finance arm down in Peru to Banco Santander, that massive negative item has vanished. This is a classic case of addition by subtraction. They aren't just selling off random assets to make a quick buck. They are executing a very deliberate, very strategic retreat from markets that they've decided are non-essential. And it's all so they can focus their capital and their management's attention where it can be the most effective. And here you have it. This is the direct result of all that strategic demolition. This chart right here shows you the new Scotiabank. A full 82% of their earnings now come from their core North American operations. Now that is a massive concentration, and believe me, it is by design. We're talking about 47% coming from their home turf in Canada, a growing 14% from the United States, and another 10% from their pretty significant presence down in Mexico. Management is making a very clear, unambiguous bet here. They believe that the most stable, the most predictable, and the highest return opportunities are right here in these core markets.
They are sacrificing global reach for regional dominance and what they hope is a more profitable and more defensible foundation for the long haul. This isn't just a pivot, this is a full-on fortification.
Okay, so they're pulling back, they're focusing on North America, and the new mantra that we keep hearing from the C-suite is value over volume. But let's be totally honest here. Every single bank CEO on the planet says they want profitable growth. Is this just more corporate jargon that was cooked up for an investor presentation? Or is this a real, tangible strategy that's actually being implemented? I mean, what does this actually mean in practice? Are they turning away perfectly good business? Are they just jacking up the fees on all of their existing customers? I'm not interested in catchphrases. I want to see the proof. Show me the proof in the numbers. Show me how this is actually hitting the bottom line. This is the proof. 20 basis points. That's your hard evidence right there. A 20 basis point, that's 0.2% year-over-year increase in the risk-adjusted margin. Now, what's really, really interesting about this slide is the specific metric they're choosing to highlight. They aren't just talking about the basic net interest margin, which is just the raw profit they make on loans. No, they are emphasizing their risk-adjusted margin. This means they are actively and successfully pricing risk more effectively into their loan book. In plain English, they are generating more profit for every single unit of risk that they take on. This is the very definition of value over volume. It's not about writing as many loans as humanly possible. It's about underwriting the right loans at the right price. For a financial institution with a balance sheet north of $1 trillion, a 20 basis point improvement in this specific metric is a massive strategic shift. It's the direct, tangible result of disciplined, focused execution. So the new strategy is in place, a leaner geographic footprint and a disciplined focus on profitable, risk-adjusted returns. Great. Now let's look at the output. Is the new engine they've so meticulously built actually generating more power and more torque? This next section, this is really the heart of the bull case. These are the tangible results that demonstrate how this whole strategic overhaul is translating directly into improved profitability and ultimately shareholder value. Let's see if the engine is running smoothly. And here it is, 13.0%. For long-term bank investors, this is the number that matters most. It's the adjusted return on equity, or ROE. This is the ultimate measure of how efficiently the bank is using its shareholder capital to generate profit. And it's up a very, very strong 120 basis points, from 11.8% just 1 year ago. Now, this isn't just a good number, it's actually ahead of schedule. The bank has a public medium-term target of 14% plus ROE, and on the earnings call, management clearly signaled their confidence that they could actually hit that target a full year ahead of their own plan. The bottom line is this. For every single dollar of shareholder capital they have, this bank is generating more profit today than it did yesterday, and management is signaling that that trajectory is set to continue. But how are they boosting that ROE so effectively? Well, it's not just about revenue. It's about rigorous cost discipline. Just look at this chart. This is the bank's adjusted efficiency ratio. Now, for banks, a lower number here is always, always better. It means they're spending less money to make each dollar of revenue. And it has dropped a full 220 basis points, all the way from 54.5% down to 52.3%. They are systematically stripping out costs and finding efficiencies wherever they can. Sure, selling those international businesses certainly helped, but this also reflects broad-based productivity enhancements and some very strict expense management across the entire enterprise. They really are building a leaner, more powerful, and ultimately a more profitable machine. And to really cap off the bull case, you have this statement from the man in charge himself, CEO Scott Thompson. Now, this isn't the standard boilerplate optimism that you hear from pretty much every executive. He is explicitly tying this quarter's strong performance directly to their full-year guidance. He is putting his own credibility on the line here, and he's signaling to the market that this is not a one-off quarter that was driven by some asset sales. He's telling investors that the operational momentum is real, the new strategy is working exactly as planned, and that they fully expect this performance to continue. This is management telling you, point blank, the fortress they're building is strong and the foundation is solid. Okay, that all sounds great. A focused strategy, rising profitability, disciplined cost control, a confident CEO. I mean, if that were the whole story, the stock should be up 10%, not down. So the bull case is built entirely on this idea of a strong new internal structure. But what if the very ground underneath that brand new fortress is starting to shake? It's time we talk about the cracks in the armor. It's time to look at why the market actually sold the stock on this news. Let's dig into the bear case and the external threats that could bring this whole beautiful structure crumbling down. And here it is, this table. This is the number one reason for the market's skepticism, the provision for credit losses, or PCLs. In this quarter alone, Scotiabank set aside over $1.1 billion to cover loans that they expect to go bad. That is up from $1.04 billion last quarter, and it's up from $1.06 billion this time last year. So at the exact same moment that the CEO is on the phone talking about confidence and momentum, the bank's own risk managers are in a back room actively preparing for more of their customers, both individuals and businesses, to default on their debts. This is the first major crack in the armor. It's a clear signal that while the bank itself may be getting healthier, they expect the economy that their customers live in to get a whole lot sicker.
Let's be absolutely crystal clear about what this means, because this is the single most important concept for understanding the market's negative reaction. PCLs are not actual losses that have already happened. They are an allowance for future losses. It's the bank's accountants and their risk officers looking at the economic forecast, things like unemployment projections, GDP growth, and inflation, and saying, okay, based on all this data, we need to brace for impact. When you see this number rising quarter after quarter, it's a forward-looking indicator. The profit number is backward-looking. The PCL number is forward-looking. And right now, they are pointing in two completely opposite directions. And that is what spooked investors.
And if you want any confirmation of that fear, you don't have to look any further than the CFO, Rajagopal Viswanathan. When he was pressed by analysts on the conference call about the risks to their outlook, he was brutally honest. He said the risk to the downside will always be macro. He's openly admitting that no matter how well they execute their internal strategy, no matter how much they improve their efficiency or their risk-adjusted margins, they are still, ultimately, at the mercy of the broader economy. He even concedes that it's a little hard to predict 7 quarters out with any real level of certainty. This statement is the absolute core of the bear case. The bank may have built a much stronger house, but it's sitting in a neighborhood with a hurricane watch in full effect.
All right, we've laid it all out. We've got the bull case, a disciplined, strategic overhaul that has created a more profitable, more focused core business. And we've laid out the bear case, a looming macroeconomic storm that could potentially wash it all away. We've seen the strength of the new structure that they've painstakingly built, and we've examined the cracks that are starting to appear in the armor. So now, it's time to weigh the evidence. It's time for the iron financial verdict. This is the blueprint you need to decide if Scotiabank is an opportunity or if it's a trap for your portfolio.
So let's break down this blueprint. The opportunity, the bull case, it's clear and it's compelling. You have a stronger, more focused North American core that now accounts for a whopping 82% of all earnings. You have powerful return on equity momentum with the bank tracking well ahead of its own targets. You have a management team that is clearly committed to disciplined capital returns to shareholders through stock buybacks, and it's all underpinned by that proven value over volume strategy, which we can see is working in their rising risk-adjusted margins. I mean, that is a solid foundation. But on the other side of the ledger, the trap, the bear case, is just as clear. Those rising provisions for credit losses are a massive red flag, signaling rough economic waters ahead. The CFO himself admits that macroeconomic headwinds are the single biggest risk that they face. Questions also remain about whether the growth they are seeing in their remaining international segments is truly sustainable. And all of this combines to create a thick fog of uncertainty that completely clouds the long-term forecast. No matter how strong the fortress is, a big enough storm can still cause significant damage.
So, we come right back to the ultimate question we asked at the beginning. Is Scotiabank's new fortress built to last? The evidence we've examined today shows that management has absolutely done the heavy lifting. They have successfully reforged the bank into a leaner, more focused, and more profitable machine. The foundation is unquestionably stronger than it was just a year ago. But the durability of that new structure is about to face its first real test. An economic storm is gathering on the horizon, and the bank is openly preparing for it. The market sold the news because it's weighing the internal strength of the fortress against the external strength of the coming storm. Now you have the blueprint. You've seen the bull case and the bear case, the opportunity and the trap. The final call? Well, that one is yours.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.